Avon Resources Limited is a gold exploration company with significant projects in British Columbia and the Yukon. Trading on the TSX Venture Exchange, symbol ABN, and the OTCQB, symbol ABNAF. Surrounded by world-class gold deposits and mines, Avon's 23,000 hectares Forest Kerr Gold Project is located in the heart of the Golden Triangle in northwestern BC. For more information, visit us at avonresources.com.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is home ownership consultant Ross Kay from thewealthyhomeowner.ca. Welcome back to the show, Ross.
Hey, thanks for having me back, Jim.
Ross, we'll start off the show with a listener question. Carmen asks, what does a firm deal mean? In logical terms, a firm deal means nothing unless it's completed. So to follow that line of reasoning, basing any conclusion on a deal not closed / completed / finalized, what does it really mean? And can Ross comment on what stat can truly infer anything valid conclusion on? I know that he does this on every show, but perhaps a comment on this type of erroneous data should be made. So, Ross, what does a firm deal that's not completed really mean?
What it means is that there's a built-in inflationary factor when a real estate board uses a current year's sales numbers against a previous year's sales numbers that have been adjusted for those deals that did not close. So this goes right directly to what your listener has asked. So generally speaking, across the industry, it's around 1%. So about 1% of all the deals written by realtors and posted to local MLS systems end up not closing. So there's many reasons. That doesn't mean that 1% of all the public is hurt by these change of minds, because usually the house is resold. But it also tells you that in some markets like Toronto, where the Toronto Regional Real Estate Board always compares this year's posted sales firm pendings against last year's closed sales, they get a higher percentage increase. There are years where the Toronto Real Estate Board inflated their numbers. They get up to over a 2% inflationary impact from that one comparison. Now, people say 2%. Well, that makes a big difference when you're claiming you're hitting records, when you're trying to create a false narrative that allow you to make commission. That's the only reason they do this. I mean, you really have to question. This listener really needs to question. Why are no bank economists, no academics, no realtors, no real estate brokers? Why have none of them addressed this? Well, generally speaking, they can't answer the question that this listener has just posed. So, you really don't want to ever look at any kind of stats that a real estate broker, a real estate board, a real estate pundit uses, because they are believing those numbers themselves. So I'm sure whoever published that number believes that number. They believe sales have dropped off. What they didn't say, I think we talked about this on last week's show, there were 29 days in February this year. That meant, and the way that the calendar rolls out changes from year to year. Last year, in other words, we had to go back to 2013 before you could actually compare 2 months of numbers. And even then you couldn't compare them because back in 2013, for sale by owners really weren't being counted to any degree. And then by 2020, they were being counted substantially. We all know Comfrey was sold and Purple Bricks bought them. There are these 1% realty brokerages across the country now, which are all basically for sale by owner companies. They claim not to be, but they really are. There are listings all over the place that are $1 that you couldn't post on the MLS for $1 a year ago. So all of those are inflationary numbers. So your listener's right. He shouldn't believe whatever he heard from this person. If it was a realtor who released it, they could be charged under provincial trading legislation in any province across the country. There is no province where that type of misrepresentation would not result in charges being laid if a consumer complained. But this listener, if you hear numbers like that, close up your ears. Don't listen to them. They mean nothing, especially right now, because the nonsense that is being talked about out there right now, it has reached a new height, a height not achieved since May of 2013. So hopefully that answers that listener's question.
Ross, we're now 14 days into a national request to close up the home sale business. We continue to hear pundits making forecasts with escape clauses built in. What are you seeing at this time?
What I am seeing, Jim, is on the ground price depreciation that is at a historic level. Now, what I mean to say by that is we are catching up to the last 2 years of correction that my company has been recording in the market. So if you go back to the shows here, you can go back to November of 2016, and we will tell you that as of November the 16th, the Canadian housing market was correcting. I understand that in the spring of 2017, the Toronto Real Estate Board was reporting 40% year-over-year house price increases. Well, that's because they used flawed metrics. It's because they fooled the public, which I guess really is what you just asked me in this question, Jim. So this is how we try to explain it. You've got this big map, this big puzzle. And when you step back and look at the entire puzzle, you can see the picture that's there. It's obvious. It's right there in front of you. If it's a map, you can see what area you're actually talking about. But the closer you start to look, the closer you get to that map or to that puzzle, the closer you get in. And then when you finally pick up a magnifying glass to look at the finest details that close up, you forget about the entire picture. That is what real estate stats are designed to do. They're designed to get you to look at a relatively small part of the market in a relatively small amount of time from a relatively biased perspective instead of you looking at the overall picture, which when you see it clears everything up for you. You understand what's really going on. That's what's happening right now. We are looking at a granular level of house price decreases already, all over the place of 10 to 15%. I'm on a website right now. One of the websites. Like, let me answer the questions a little bit easier for your listeners so that your listeners can go out and fact check this themselves. The reason why we said sold sites were dangerous for the public was because they form confirmation bias. Unless you understand how to read those sold stats, you are oblivious to what's really going on. Everything you hear from a real estate board will be reinforced when you're looking at those sold sites. And from the day the Competition Bureau forced those sites to go live, which again, you can go back in the show, we warned everybody why they were bad, because in an upward trend of a housing market, they're really, really bad. And you have to wait until the market rolls over fully before they become any value at all. So that value, folks, is out there right now. Because if you go look at any of these local realtor websites, like the public has to rely on these realtor sites. We don't, but the public does, okay? You never had that availability before, but you do now. So you go to your local marketplace and you find a sold site, a local realtor who is posting solds from their local real estate board. And then you look at the sales of only the last day, or the last 2 days, or the last 3 days, the sales that have taken place. And then you drill right down to those exact homes that are sold. The beautiful part is right now, so few of those homes have sold. It's a infinitesimal share of the total stock of homes on the market today that actually sold yesterday. When you look at it, you start to gain an awareness of what's really going on. First of all, many of these sites allow you to look at, when you drill down to yesterday's solds, you can pop back out and check what those houses sold for a year ago, 2 years ago, 6 months ago, even a month ago, you can see what happened. We're looking at houses today on the way that we get the data, and we can see the vast majority of the houses are selling below 95% of their list price, where in February, they would have been selling probably 5% above their list price because of the way that the real estate agents were operating in their markets. Okay, there is a 10% differential against the average listing price of the houses that are actually selling. So we're not going to talk about the 98% of the homes that aren't selling. We're only going to talk about the 2% of the homes that sold yesterday, or 1% of the homes that sold yesterday, or 0.5% of the homes that sold yesterday. So of all the homes listed for sale, you may only have 0.5% of all the houses that were listed for sale that was sold yesterday. Maybe it's less than that, depending on the market you're looking at. When you get that granular of a level, something that has never before been possible, this opportunity for the Canadian public, academics, economists, anyone out there to have a granular view of the myths and the falsehoods about a housing market that have been perpetuated by organized real estate and have been believed up to the highest financial oversight in this country, the Bank of Canada. They believe what Greg Plump has told them for 25 years is now debunked. And it's debunked with a couple clicks of a mouse. I'm looking at houses in the Greater Toronto area. I'm speaking to you right now, Jim, because this is part of the market that'll be we're addressing today in our own internal working. Houses are selling at about $210 a square foot. Single detached houses that have been built in the last 4 or 5 years, custom built one-offs, are now selling for about $215 a square foot. That is unimaginable. And this goes back to what we told everybody, how you understand housing markets. Go out to Calgary and see what the brand new builder, Mattamy for that matter, is building houses for out in Calgary. They're building for under $200 a square foot. That means the builder can build the same house in Ontario or Vancouver for under $200 a square foot. There only is a small adjustment for the land value. Your municipalities dictate what the cost of the land is going to be through their zoning bylaws. That is what the reality of this housing market. All of the myths that we have talked about on this show since you started interviewing me are going to be debunked over the next 6 months. All of them, because there are sold sites, there are real estate agent websites where sold listings are posted, and anyone with a computer can access them. Many don't even have a verified login. You can log in with a phony name, phony email address, and they'll still give you the access. When you get to these sites, you can drill down to individual homes and check. So I'm talking to you right now, Jim. So I've just pulled up our own platform here. I can't really explain to you how we get fed information, but we get it fed. We collect from about 252 data points from across the country now. We've been getting these daily now for almost 2 years. It used to be weekly, now it's daily because the system has been so corrupted that it makes us easy now to get this information. Here's a listing: 43% of list price. First listing. Second listing, 92% of list price. Third listing, 97% of list price. Okay, so we're averaging 97.5% of the list price. We can jump down to a category of homes. Here we go, 96% of list price. Go check your Toronto Real Estate Board stats for last month. Find out what they were telling everybody prices were selling for. Here's one that fools everybody. There's a house up in Brampton that sold yesterday for 108% of the list price, is what the real estate agents say. What they don't tell you is that house is actually around $78,000 below what it would have sold for 2 weeks ago. Here's one in Milton, $80,000 lower than what the identical home sold for 43 days ago. These comparisons, as we said in last week's show, have never been available before. So it's very simple. What you're hearing from housing pundits about, V-shaped recoveries, the housing market's going to be busy in the fall. It's just the market's on hold. Supply and demand. It isn't supported in the data. I hope that the public doesn't believe that magnifying glass even shows you anything any longer. Because when so few homes are actually selling, that there's nothing under the magnifying glass anymore. Now you've got to look back. You've got to see the whole picture. And when you see the whole picture, it is nothing like you've been told it was for the last 7 years. The picture doesn't resemble anything that you've been told before. It debunks everything that you've been told. We talk about house price illusion on the show, Jim. That's how you debunk house price illusion. What you're seeing now is that illusion evaporating in real time, and a magnitude of scale we haven't seen before. This makes the 2017 correction in Vancouver pale in comparison. Vancouver has still been correcting, but it's been correcting at a slower rate. So slow that when you look at these sales sites, you believe what the local real estate board's been telling you, which is false. Because at the granular level, meaning identical home against identical home, prices have been falling. Now, you get to see that coast to coast.
We'll have more with Ross Kay right after this.
Engineer Gold Mines is focused on the exploration and development of the historic high-grade Engineer Gold Mine situated 32 kilometers southwest of Atlin, British Columbia. Engineer Gold Mines is fully permitted for surface and underground exploration with the drill program now underway. Engineer Gold Mines Limited trades on the TSX Venture Exchange, symbol EAU. For more information, please visit us at engineergoldmines.com.
Cypress Development Corp. is developing a world-class lithium resource in the heart of Clayton Valley, Nevada. The size of the resource makes the Clayton Valley project a premier asset with the potential to impact the future of lithium supply. Cypress Development Corp. trades on the TSX Venture Exchange, symbol CYP, the OTCQB, symbol CYDVF, and on Frankfurt, symbol C1Z1. For more information, please visit our website, cypressdevelopmentcorp.com.
Welcome back. We're speaking with Ross Kay. Ross, we're hearing anonymous employee comments coming out about banks closing up branches, staff having a hard time meeting new qualification guidelines themselves, and massive bank layoffs with no rehires being suggested as a way for banks to protect shareholder dividends. What do you think will be the final outcome?
What I think the final outcome will be is the same outcome that has happened over and over and over again. And the beautiful thing about perspective, the beautiful thing about studying housing markets for decades. I know I make myself sound like an old guy in the show. I mean, I'm only 59. I'm not an old guy. But I do have a tremendous amount of experience because I started in the business at such a young age. I started studying housing markets before the previous correction began. I got to watch the consequence of all that. I know across Canada, the number one sales agents in some of the major real estate markets in Canada today, who were real estate agents back in the 1990s, went bankrupt because of the correction, the previous correction. These are the top names that we see on television. I don't mean the pundits who haven't sold any homes that risked their careers because they have nothing to lose, stating falsehoods on television. I mean the guys that have sold, they're the top in the business. The guys that are selling 100 homes a year. The guys that can't afford to be giving forecasts or commentary. The type of guys who are just simply on there selling their book of business, selling their listings. These people all went through, some of these people went through some tremendous hardship in the previous correction. So my perspective is that. My perspective is when banks previously closed up branches, and for a decade, they consolidated their business. Only when things started to get busy again, they started to release commercial buildings or places in the malls, and they grew their branch profile again. Banks react very, very quickly to protect their profit. And it is so quick, and it is the algorithms that they use in all the decisions they make are so highly tuned, the public cannot even compete. So these comments that you're hearing, many of them will be true. Many of them will be seated in the appropriate places where they become heard, so that people will make decisions based upon them. So branches closing up, of course, branches are going to close up. The banks need to save money. They're going to lay off staff, consolidate their branches, and those buildings will become available, or those leaseholds will become available. Now, a lot of the banks had standalone buildings built within a mall or within a commercial developer's holdings, and they're leasing those buildings from the developer. They have 20, 25-year leases on those buildings. Those ones are not going away. It's the small branch in the malls that will disappear. You may see low-volume branches that they've been in tenancy for, let's say they've already been in there 15 years. They may pay off the landlord to exit that tenancy. But generally, it's going to be your smaller branches. They're going to consolidate the branches, and you're going to just have fewer places to go. They're going to move more online. This will be your next wave of online business. Yes, bank staff will be laid off, and it'll be the junior people that are laid off, where the bank can minimize their exposure to an immediate payout for laying someone off who's been with their business, their bank, for 15 years. They don't want to pay 15 weeks of wages. Will these rehires happen? Not in the immediate short term, but going forward, they will have to rehire some in the future, because unless the Canadian public moves away from the personal contact experience, the need to have personal contact, they are not going to be fully immersed in the online banking. I mean, to us, Jim, online banking is terrible. Okay, it's okay for checking your accounts. It's okay to check if your CERB is going in. It's okay for many reasons, but it's not when you're borrowing money or when you're making a financial decision or you're getting advice. Online is no good. You need to be face-to-face so that you can judge the person who's talking to you, so you have an understanding whether or not they're telling you the truth, because you'll sense it, especially if it's a husband and wife in there. Believe me, one of the two of them is going to sense when someone's trying to pull the wool over their eyes. You're not going to sense that at all. You're going to have to rely on online guides or online ratings or online surveys to make those decisions. Doesn't make sense. So the banks will have to retrench at some time in the future, in our opinion. Whether they have the mobile mortgage managers, the mobile car loan managers return, I don't know, but they'll have to do something with face-to-face. What do I think the final outcome is going to be? Well, you're going to see tighter lending guidelines over the next 4 to 6 months. Banks are going to have to do that because the OSFI is going to make sure that they don't leverage themselves too far. But the second the OSFI guidelines are relaxed, or the banks return to their holdings that they need to keep in reserve, once those holdings are returned, the banks will start to return to their old practices, because banks have CEOs who are paid bonuses based on the growth of the bank stock, how much the profits the bank generates. Those bankers are already in full force across the nation speaking their book of business. Don't worry, because they don't want to have a run in the bank. Our dividends are secure. Don't worry. We don't want to run on our stock. We're doing everything we can to help the Canadian public. Not really. You're still making the profits you were making before. So that's what I mean when I say these are all patterns that repeat themselves over and over and over again. And for your listeners who haven't been through this before, everything you're being told today, you've heard before. I know I've heard it personally twice. I've heard the exact same arguments, the exact same talking points, at least 2 times before. Those talking points were true for a couple of years, and then they went to the wayside. Because profit, the need to drive profit under the current agreements with the CEOs, how they earn bonuses, dictates what's going to happen in the marketplace. So, yes, I am sure that if you're working at a bank, the bank is going to make it harder for you to borrow money because you may be one of the people that the bank is thinking about laying off. Whoops. Nobody's thinking about that, are they? That's true. The bank, you may be a lower tier employee at the bank, less experience, and or someone who's very expensive for the bank to employ, and they're thinking, this is someone we could be laying off. Okay, we're going to make it harder for them to borrow money, but we're not going to tell them we're thinking about laying them off. It's just a consequence. We're going to make it harder for you to borrow money. That should be a red flag for you if you're working at a bank. So, yes, banks will be closing up branches. Yes, staff will be being let go. Yes, there'll be a tighter margins on their mortgages. You're going to have to be, in the short term, it's going to look like you're going to pay higher rates, but in the marginal long term, meaning the next year to 3 years, no, you're not. The economy cannot recover quickly enough that the banks are going to have to raise your rates. I encourage you to speak with some form of a mortgage professional, pay them for the advice. Do not book your mortgage through a mortgage broker, allowing them to make commission or allowing you to pay them based on whether or not you get a mortgage from them. Pay them for the advice. I understand mortgage brokers don't think this is legally possible. I understand that, okay? What I'm telling you is, you can call the provincial regulator and ask them if you can pay for advice from a mortgage broker, even if you don't book the mortgage from them. And the regulator's going to say, what are you talking about? No one's ever asked us that before. Well, I guess if you're not getting a mortgage from them, sure, you can pay them for advice. I know this because we've made the calls to the regulator ourselves, and they were shocked. They were shocked. Actually, they couldn't believe the question we were asking them because they couldn't believe anybody would want to do that. We say, who in their right mind wouldn't pay a mortgage broker $1,000 to book them a mortgage on the best terms, on the best rates, on the best, in their own best interest, irregardless of the commission point or the points that the mortgage broker is able to earn? Because the mortgage broker can't earn those points. You're going to get those points on the discount of the mortgage broker is now giving you. Yeah, it's a long answer to a short question, Jim. But, yeah, banks follow cyclical patterns the same as the housing market.
We'll have more with Ross Kay right after this.
Media recognition from Bloomberg, Reuters, recycling trade publications, patented process for 100% recovery of critical metals, including cobalt, lithium, nickel, manganese, aluminum. American Manganese is focused on recycling lithium-ion batteries for electric vehicles. American Manganese trades on the TSX Venture, AMY, the US, AMYZF, and Frankfurt 2AM. For more information, visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com.
Welcome back. We're speaking with Ross Kay. Ross, a listener asked, I sold my home in Vaughan in February. Whereabouts is that in the Toronto area?
It's just North Toronto for the sake of the argument. It would be similar to, Vaughan would be similar to Burnaby for Vancouver.
I sold my home in February. We had a bidding war erupt and the offer was accepted. Was a firm 19% higher than our asking price. My wife was wondering if Mr. K thinks our June closing will take place because the buyer's home was still not on the market when the shutdown started. I think a lot of people are finding that happening.
Yeah, so Vaughan would be like Surrey, not Burnaby, yeah. Excuse me. Anyways, okay. There are many situations like this across the country. Many. Thousands. Literally thousands. I would estimate there are probably right now about 80,000 homes that have been sold that are in the queue. We call it in the queue to close. In other words, like the first question you posed to me from that listener, what is a firm sold, a pending sold, or a firm sold pending? and then a close. When they're in the queue, they're in the process expecting to close. There are over 80,000 of those sales now in the queue where the loan-to-value ratios on closing will not support the financing that was obtained on the property. In other words, as loan-to-value ratios are dropping rapidly right now, the banks are wondering, if they paid 19% over asking. Let's realize what this listener is saying. They had their house for sale, and some random home buyer with no experience evaluating the appraised value of a home said they would pay them 19% over the asking price. And it was sold for that number, 19%. If it was $1 million, that means it was $190,000 more than what they believed the home was worth. Now, sooner or later, there's going to have to be an appraisal done on that home to close it. So the buyer may have required $700,000 worth of financing for the sake of the argument. Okay, they had $300,000 down, and they needed $7. Well, they were approved for $9. Okay, so they put an offer in that property, 19% over asking price, that still was below their pre-approved threshold. They went in firm, they bought the house. Okay, now that property is no longer worth that because the appraisal that would be done would never now arrive at a 19% over asking. The appraiser has to look at the market. They are legally obligated to look at the market impartially. And what your listener probably doesn't understand is the appraisals that are done 500,000 times a year across Canada to allow a sale to take place with a real estate brokerage are done on the benefit of the bank. Those appraisals are never done on the benefit of the home buyer or the benefit of the home seller. They're done for the benefit of the bank. So the bank has something in writing to protect themselves in the event of foreclosure, or in the event of the OSFI stepping in, or in the event of their shareholders seeking the board of directors to being held accountable for allowing fraudulent loans to be placed, or the CEOs, the VPs. What that means is there's no way that an appraiser is going to appraise their property at 19% higher than the asking price. They're not even going to appraise it at the asking price by all odds. As we're seeing today, when we're looking at solds today, houses are selling a minimum of 7% off the list. Okay, so now we're at 26%. I know we've got up and down numbers here. I'm not going to, belittle the little bit of difference. We're just rounding things off here to explain what's really going on. So now we're at 26% off. Oh, the appraisal comes in at 26% less. So now we take the property is actually worth maybe $920,000. So you have $190,000 overpayment plus an $80,000 drop in price since between the day they bought the home to the day they're going to close on it. That is an extra $270,000 of financing that is no longer available. Those people have to come up with $270,000 cash extra. Nobody has that kind of money. Nobody has $250,000 sitting in the bank, because where's all their money sitting? Where is 3/4 of the wealth of all of Canadians sitting? It's in the house that they're sitting in. That wealth is the house they're sitting in. It isn't in the bank. They can't draw upon it. There are about 80,000 of those closings that are set to take place between now and the end of June. Think about that, folks. Over 80,000 sales between now and the end of June are expected to close with greater loan-to-value ratios than on the day that they were purchased. It is a staggering change. There are going to be properties that can't be closed upon, not by the irresponsibleness of the home buyer, although I would say it's irresponsible to allow a home buyer to enter a bidding war without that buyer having appraised value done on the property, which is what organized real estate has refused to do for 20 years. Those people are now in a situation where they can't even borrow the money to close. They can't get the mortgage. They can't get a personal loan. Line of credits are being more scrutinized. That money's not available. All of those houses are going to come back in the market. Look, these listeners, you got hosed, taken advantage of in February. Whoever your realtor was who allowed you to enter these terms without putting protections in place was unethical, and they should be charged, in my opinion. I would say that this is a 100% winnable case in the blink of an eye. That isn't going to do you any good, because you have to understand, you can sue any real estate broker in Canada you want. They will not have the money to pay your lawsuit. The money will not be there. The brokerage will get out of liability because of the independent contractor agreement. Your errors and omissions insurance does not cover that. Okay? There may be 0.2% of all real estate brokers in Canada who could access the funds to cover you on one transaction. The other 99.8% no. So you're just in a situation that you're going to have to deal with. You're going to have to get a compromise of some sort. You're going to have to be speaking with your lawyer. Your lawyer is going to have to speak with the buyer's lawyer. There's going to be a long, drawn-out process. There's going to be extra financing in one way or another that will be arranged. It will be exceedingly higher interest rates. You're probably going to have to do a vendor take-back of some sort on your home if you want to have it closed. Now, that's what we should end today's show with, Jim, is this. In the 1970s, 1980s, and early 1990s, it was common to have a vendor take-back of some form of another on a mortgage. What I mean to say by that is that you would sell your house, and the buyer would get for the sake of the argument, 50% financing at the bank on a first mortgage, and you, the owner of the home, would hold a second mortgage for another 20%, giving them a total of 70% finance. You would receive returns on that money. Hey, sometimes it was like 15%. So the returns were very, very good. Even with the claims the local stockbrokers were making, how you had to earn 12% return to be able to retire in 30 years, which is what they were saying in the late 80s, early 90s. That's how mutual funds became the talking point for almost 2 decades. Vendor take-back mortgages are going to have to be appearing. The problem is the mortgage brokers with the qualifications and the skill to deliver a vendor take-back mortgage are next to nil today. Your real estate brokers, your sales reps today haven't seen vendor take-back mortgages in almost 25 years. So that skill is gone. It's evaporated. It's disappeared from the industry. Many of the lawyers, the real estate lawyers, they haven't did vendor take-backs in a long time. I'll tell you where there is an answer. The answer comes from the commercial realtors. Commercial realtors still do this regularly. Commercial realtors are a far higher degree of profession than your residential realtors. A commercial realtor is dealing with business people every single day. They're not dealing with regular consumers. They're dealing with business people who have profit and loss statements, projections. They have shareholders that they're accountable to. Commercial real estate brokers are the real professionals of the real estate industry. They're the people that have to stay on top of all the legal ramifications of the business. Now, I'm not stroking commercial realtors here when I say that, because they're still realtors, okay? In the 80s and the 90s, commercial realtors had a real bad rep, same as mortgage brokers. Mortgage brokers had a terrible reputation back then. But there are still good people out there who know how to handle these things. And this is really the answer to these people's question. You are going to have to come up with some creative financing solution to the situation that you're in. If you want to proceed with this sale and assist the buyer in closing, you're going to probably have to do some form of a vendor take-back. That doesn't preclude the buyer from securing financing at a bank, say 50%, and you holding a second mortgage for whatever is outstanding. The beautiful thing about this situation in a vendor take-back mortgage is this. Number one, always talk to your lawyer and let your lawyer handle the situation. So don't take my advice, or you can listen to my advice, but then go see your lawyer so that the paperwork is handled properly and you're protected. But the beautiful thing about a vendor take-back mortgage is this. if the buyer has a first mortgage of 50%, that means you, the vendor take-back mortgage holder, has 50% of the property's value to work with. That property can drop 50%, can be cut in half. And at that time, if you become the owner of the property, you probably can rent it out for more than what you were getting on the first mortgage for all of the outstanding mortgage that's available. There really is a no-risk situation for vendors that find themselves in that situation of being asked to hold a vendor take-back mortgage, as long as the paperwork is done to protect them. So the long answer to this listener's question, Jim, but I know there are about 80,000 purchases in the queue right now that probably really shouldn't be able to close. Whether or not CMHC is going to come up with some newfangled policy, or the Bank of Canada institutes some new policy, or the OSFI institutes some new policy, or even the Government of Canada institutes a policy, like maybe something crazy, going back to 40-year amortizations on a mortgage. Maybe something crazy, like interest-only mortgage payment. Barring all those things happening, you still have an out. It's called a vendor take-back mortgage. Anyone who has sold their home today or has purchased a home that is not closed but will close in the next 3 to 5 months, I encourage you to investigate vendor take-back mortgages. Talk to your real estate lawyer. Make sure they're proficient in handling a vendor take-back mortgage, and start to consider that as an option, because you want to be prepared for a situation that may happen. Hopefully, the government's going to make some changes that are not going to cause you to have to do that. But you want to be prepared. You don't want to be the person sitting there on the day of closing with your current home not being closed, but with you having enough money available for the home that you're buying, the owner of the home you're buying, to sue you for damages. You don't want to be in that situation. So just start thinking about your options, because as far as our numbers are looking right now, Canada coast to coast, there are about 80,000 home sales that are pending, set to be closed between April and July the 14th, that right now current lending standards would not support the buyers owning the home without them having to come up with some more cash somewhere. Amounts of cash in the tens or hundreds of thousands of dollars. It's best that you look at that now and you take actions to safeguard your family for when that closing date actually happens.
Ross, thank you so much for the update.
Hey, thanks for having me on, Jim.
My guest has been home ownership consultant Ross Kay from thewealthyhomeowner.ca. If you have any questions for Ross or any of our other guests, you can send them to info@housestreet.com. Find us on Twitter @HouseStreet. Our YouTube channel is Talk Digital Network. We're also on Facebook. I'm Jim Goddard. Thank you for listening.
Comments made on HouseStreet.com radio